The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to Honest Money. I'm Warren.
Pieter Villers from Money Marks.
Today we're talking, and it's almost like a clickbait topic, Pieter, but it's real. It's the most important investment decision that you make. And if that sounds like it's too good to be true and a whole lot of nonsense, it's not. It's something that we both believe, and equally that it's been proven time and time again. And where the thing that you have to decide, it's called your asset allocation. So what does that mean? It's the combination of cash, property, government bonds, corporate bonds, and shares. That decision about how much you allocate to each of those types of assets, I feel, I think I'm speaking for you. Sorry, I shouldn't do that. But I feel, and Pieter feels that that's the biggest, most important decision that we can make for our investments, and possibly much more important than whether you buy this share, that share, how much you've got in dollars, how much you've got in euros, etc., etc. Get the mix of assets right. You're going to probably win the game. Get that wrong, you might end up working for a horrible boss until you're 90.
Yeah, exactly. And oftentimes, especially in the new dawn of social media, if you go on social platforms, everyone has this new type of investment that's now going to make you rich, and a lot of clickbait. But being a successful investor actually comes down to just getting the basics right and doing that consistently over a long period of time. And breaking everything into its fundamentals is, what do you actually invest in? The assets, the building blocks. So assets at the fundamental level is basically like little blocks that you invest in. So if you look at a salad, say you want to buy a salad.
Oh, that's healthy.
You've got you've got the tomatoes, you've got lettuce, you've got
cucumber,
some cucumber, some meat, some chicken. That's what you put into the salad. So if we kind of use that scenario, that reference, the assets are the little things you add to the salad. And salad is now your investment. Now, sometimes, eating a whole salad just containing tomatoes may not be the most fun thing in the world, but it may be appropriate for what you're after. But oftentimes, a blend of everything makes sense. So deciding, I think, let's start with what asset classes do we get. So we get the traditional four, I would say. Equities, shares, stocks, same thing. It's when you own a piece of company, the company does well, it grows in profits, and you sell that share later at a profit. You make, you make a profit. There's some capital gains tax on that we can talk about. But also, if the company makes a profit and they want to pay it out to the shareholders as a kind of a good gesture, earn that money, so you can earn income but also get growth. Property, in a sense, as an asset class that you can invest in, is more like buying maybe like a unit trust that has exposure to different types of property, as opposed to buying physical property. That's a different type of investment, where you also get, if the property increases in value and you sell it at a profit, you get a capital gain. But you can also earn a rental income through that we call it a real estate investment trust, the REIT. Then we get bonds. Bonds is almost the reverse of you taking out a loan from the bank to buy a car. You giving the bank money, and they then use that money to invest in their type of ventures. So this could be corporate companies, could be banks, could be the government. We're giving them money, and they're paying us a certain amount every month, a coupon they call it. So that's kind of like an income.
And then they give you money back.
And then they give you money back, yes, at the end of the term, maturity. And then you get cash, which is quite easy. It's money in the bank, physical cash. It's cash that you put in a money market account, a fixed deposit. So you get a return on that, an interest. Those are the four main type of asset classes. And then, we always get that alternative asset classes. We get the private equity, we get the hedge funds, we get the type of crypto is now also a regulated asset. So we're not going to really touch on those assets today, because the other four is the fundamentals of most investment portfolios. And I think we can just focus on them for today.
Yeah. Please, I don't want to talk about cryptos. So maybe just to understand. I'm gonna bypass your salad analogy now. When you're driving from Joburg to Cape Town, and you say, I want to get there as fast as possible, and you need to design a car to get you there. The temptation would be to say, you know what I'm going to do is I'm just going to put 4 wheels on the ground, and I'm going to buy the biggest engine I can, and that's going to be my car. And so that's great if you want to get from A to B as fast as possible without worrying about potholes, taxis, other drivers, rain, all that stuff. Then you just get the biggest engine and you go. And if everything works out perfectly, you might get there a bit quicker than everybody else. However, there's a very good chance that life is going to happen. It's going to rain. You're going to hit the pothole. You're going to have to brake or swerve and all of those things. And if your car's only got 4 wheels and an engine, then you're in for trouble. So that's my analogy, Pieter. And so shares is your engine. Shares are the thing that will, over a decade or two, will give you the best possible capital growth above inflation. So the best real growth. And that's been proven time and time again. But you can't drive a car with only an engine. I know it's tempting, but believe me, that will cause heartache more than anything else. So you need to have suspension, you need to have brakes, you need to have shock absorbers and all of those things. And that is where you have your cash, your bonds, your property companies, and the like. And putting all of that together is how you design your car to get from Joburg to Cape Town. So for a lot of people, they might say, well, I you know what, I want to be absolutely safe. So then they get the biggest brakes they can, they get the best suspension and everything. And then they put the tiniest little engine possible, which means they might never get to Cape Town. They might die of old age before they get to Cape Town. Or they get there long after whatever it is that they needed to go and see. So you have to always have an engine in your portfolio. Always have to have exposure to shares. And I think a lot of people are afraid of the stock market, whether you buy it in an exchange-traded fund, in a unit trust, or in direct shares if you must. They worry about it because people like you and me will talk about shares a lot, and the media will write about it and say this thing went up or it exploded or whatever the thing is. So the stock market is scary to people. But there are ways of accessing the market in a fairly simple way. However, you have to make that call. You have to be in shares. You need an engine in your portfolio. And as I said at the start, though, you can't just only have a portfolio of shares because then accidents might happen. So I think just getting that combination correct is very important. And your brakes, your cash, for example, you might say, well, cash does nothing. And I believe that. Cash barely tracks inflation. But gee, when you need the cash is like when you need the brakes in the car. You're very happy to have it at that time.
Yeah, absolutely. And I like the analogy of the car because it's essentially what we want investments to do ultimately is for us to reach our goals. It means we're driving from Joburg to Cape Town. It's quite a far drive that you have to plan it. Yes, you can take the chance and try and drive there in one day with the biggest engine and maybe you get there, maybe you don't. Chances are something will pop up and you're probably not going to reach your destination. So what is important to remember for investments is there's a lot of risk involved, and we can maybe also expand a bit on what risk really means with investments. I think the biggest risk is not reaching your goal in time. You have to be in Cape Town at this specific date for this event, and you're late. It's going to suck. So we need to design a car that will get us there. And maybe some people start driving from Joburg, others start driving from Durban, some drives from Paarl. Maybe it's different distances, and for those different distances, we create different types of cars and different types of engines because they have different time periods that they need to be there. So I like that analogy. So let's say, right, so we understand the fundamentals of the equities, bonds, cash, property that we put together. So is there a guideline to know how much equity? So we know we need to have equity always, but how much do we add to a portfolio for these different distances that we'll drive, these different goals that we'll have? Is there like a general kind of rule of thumb to follow?
Yeah, I think there is. And I mean, I think maybe just to start and say, everybody, if you're looking at your whole portfolio of investments and your lifespan. That's the important thing here. And if you think that you're going to live for at least another 5 years, everybody needs some allocation to shares. And I feel for it to be meaningful, in other words, for it to give you the chance of growing faster than inflation, you're probably looking at least 35% in shares in the stock markets. And then at the other end of the spectrum, if you're 21 years old, your parents are loaded, you're never going to need to look after yourself financially in the short term. You're covered. You could be that person that has close to 100% in shares. But for the bulk of us, I think 35% at a minimum, up to around about 75% in shares as a maximum. I think that's a very nice range. What's interesting about that is that if you look at the retirement fund rules, that's kind of the ranges that they would work in as well. And so that what you realize is the people who made those rules maybe weren't as stupid as everyone thinks, that rule makers actually know what they're doing. And I think it's a good combination. So 35 to 75. And then the balance, I'm not too fussed about, let's say you're at 75% in shares. If you take the balance, 25%, and you equally divide that to cash, bonds, and property, I think that's fine. If you're 21 years old and you have 75% in shares, then maybe the balance should be in property companies and bonds, not so much in cash. I'm going to say obviously, which is wrong, but you always need your emergency fund. We're not including an emergency fund in this conversation. So I think that's a good range for me. The thing to understand is time horizon. So how long are you planning to invest? Because if you're planning to invest for 10 years or longer, then having a high allocation to shares, that 75%, I think makes sense. The other thing is your stomach, because your stomach's important here. And I'm not talking about your six-pack or your book. I'm talking about your ability to live with markets going up or down. And maybe, and so I know the investment jargon, they'd say that's risk tolerance. And I think we need to talk about that a bit. But so your time horizon and your ability to stomach those big moves is probably the two biggest things over and above your actual financial capacity, how much money you've got to be able.
Yeah, absolutely. And when we talk about 75% equities, it could be at an entire portfolio level. So because chances are we're going to have, let's say, a financial freedom fund or a retirement fund that we're contributing that's, let's say, 40 years away. But we also have a medium-term goal of saving for a house in 7 years. There's a car deposit fund that's 3 years. There's a travel fund that's 12 months. So each one of those should also be looked at individually, because kind of saying 75% in totality, we need to be broken down into each different goal, because we're looking more so at the time horizon for that specific goal. So when we invest money, we always have to have a specific purpose behind it. It shouldn't just kind of be wishy-washy. I'm putting it in the market, not really know what it's for. It should be intentional. So maybe at a macro level, it would be 75% equities. But for retirement or financial freedom, you could be more than that, even now with the restrictions of retirement funds. But outside of that, maybe a tax-free savings account or a discretionary account, you can go higher than that amount in that specific fund. But then in something more short-term, like a house or a car deposit, you'll go more conservative. Maybe allocate more to cash and bonds, maybe a bit of property, because you never want to have a lot of equity in short-term investments just because the markets may drop at that specific point. So if we zoom out and look at everything, I think that would be my view of looking at the entire portfolio totality. There's a couple of other segues that I think we can also talk about, the risk and volatility and what that means. But I'm curious if we, in your opinion, if you look at the 75% equity, does lifestyle assets include that, or is it just investment assets, like a house and a car? Do people account for that as like also being part of a property investment if it's a primary residence, or is it outside of?
You're teeing me up to upset a few people here. I mean, I always smile when I get a balance sheet from someone that I haven't met for the first time, and they send it to me and they put under their assets, they say, I've got these 3 cars and this holiday house and my primary residence. Now, the bank might view your houses as an asset, and They might also want to see how much they can lend to you. They would say, okay, that's fine. We view that. But a good investment planner would not look at a house and a holiday house as an investment asset. The reason? Because your primary residence is where you live. And all it ever does is cost you money. So you're paying rates, you're paying levies potentially, you've definitely got maintenance costs and all of those things. And so it's not an asset from that perspective. Unless you live in a 20-bedroom house, you live in one bedroom and you're renting out the other 19, maybe, and I'm obviously exaggerating, but maybe then it's an investment asset that generates you an income as well. Definitely holiday houses. Unless you're renting it out most of the year and you only stay there 1 year a week and the rest of the time it's paying for itself and growing in value, it's also a lifestyle asset. And please don't get me started on cars. I mean, cars are just not, that might be a great lifestyle choice that you're making and good for you. Well done if that's what's important to you and it's not compromising your life. But surely it's not a way to make money unless you collect cars, and we're not going down that rabbit hole in the show. So I think I ignore the lifestyle assets from an investment perspective.
Yeah. So we refer to that portfolio balance as what are you investing in outside of the lifestyle assets. So we get investment assets, which is typically what you invest in the markets and the bank and all of that. And then lifestyle assets, stuff that you benefit from, but you're not really viewing that as generating an income from. So we just want to make that distinction. So I think let's talk about risk, because I think risk goes hand in hand with assets allocation. So risk in the sense of the investment world, I view it as 3 types of, maybe even 4 types of risks that we can kind of separate. So I spoke about the first risk already, a risk of not reaching your goal. I think that's the worst one of them all, because then what's the point of us investing? And that might mean not investing enough, might mean investing in the wrong types of assets because we thought we will get there, but then the market's dropped and now we have 30% less money because we went too aggressive. It might be we go too conservative in our investments that's meant for long term. So we've got 40 years before retirement and we're putting everything in the bank. There's that risk that we're not going to be there. And that ties into the second type of risk called inflation risk. So we know that money becomes worth less and less every year. It's this little invisible monster that eats away the value of your money, because you'll have the same physical 100 Rand note, but every year it will buy you less because everything becomes more expensive. So we need to beat inflation at the very least. That's why if we say equity is the best inflation beating asset class, it means statistically over the long term, if we look back far away into the past, it has beaten property and bonds and cash and all of that. So inflation risk, then longevity risk is another one, that we live too long for our money. So our money runs out before we run out. That's also important to plan ahead for in retirement. But then let's talk about volatility risk, because I think that's probably the one that most people are familiar with. If we say there's a risk investing in equity, it doesn't necessarily mean you're investing in risky companies and you're being like making silly choices.
Gambling,
yeah, essentially buying small cap stocks and hoping they go to the moon. It's more so being conscious that if you do invest in the stock market, it can in the short term go up and down quite frequently. There's no way to really predict that. But it's also important to always zoom out and look at the long-term trends. If you go now and Google S&P 500 index and you look at the 1 year return, you probably see a lot of zigzags. If you look at the 30-year return, you'll kind of see a general trend going upwards. As long as we as humans exist and we continue to innovate, the market should go up. I believe that's a hill I'll stand on. But in the short term, if you look at over COVID time, markets dropped by 30% in a period of a month or two. That can happen. So when we say we want to stomach that, we have to have a risk tolerance for that. Just means that we need to be aware of, if we're going to invest 100% equities in a fund because it's 20 years away, we should just be cautious that if that fund do drop with 30%, we don't make emotional erratic decisions and cash that money out, because that's probably the biggest mistake you can make, is being scared now. Oh, what's going on here? Let me cash out, put it in the bank. I'll buy the dip and I'll sell at the top. All of that, you're gonna hurt your portfolio much more than just sticking with that portfolio. So that's what we mean by volatility risk. It can go up and down. For equities, cash, on the other hand, is very much stable. It might go a little bit up and down if they change the interest rates, but that that doesn't happen too abruptly, but it also means the trade-off for that is less growth, less inflation beating growth than the other asset classes. So generally, the higher the risk, the higher the return. I'm very general now. It doesn't always mean like that. Don't go and gamble. That's not what we're talking about. But if we look at the asset classes, that's kind of the trade-off. If you want a higher return, you have to take more volatility risk. So being specific on what type of risk we actually.
Yeah. And I think human nature, we love certainty.
Yeah.
And so most people with a smartphone, at the start of the day, one of the first things they'll do is they'll check their weather app. Now, if you go and study the accuracy of weather apps, what you'd know is I think a flip of a coin is probably more accurate than predicting the weather than your weather app. However, we do it anyway.
Yeah.
Why do we do that? Is because we want someone to tell us what's going to happen in the day, even though we actually know that kind of a waste of time, but still we feel like we're a bit more informed than before. And so we like certainty. So when you buy certainty in the investment world, that means you put your money in cash. Well done. What you've done is you've got certainty. Now you're going to look at your account. You can do it every single day. There won't be a single day where your investment has gone down. There's no volatility. It's not going up and down like a sore tooth, but it's just incrementally adding it to itself. And so over a week or 2 or 3, you're going to feel really clever because everything's gone up. Your friends are probably upset because the news is telling them that their investments are down and the world's gone crazy because of volatility. 10 years later, your investment has never gone down and you can't buy anything anymore because the buying power of your money has evaporated. Why? Because that's the cost of living. Cost of living eats away at the buying power of your money, and cash just never tracks the buying power of your money. It will always do worse than the buying power of your money unless you're doing it over a very short period of time. So understand that things going up or down, volatility, I would look at it like the tide. It's if you build a ship and it's a watertight ship and it's big enough and it can deal with high tide and low tide, that means volatility has no impact on it. It's just moving you around. Might get a little bit seasick every now and then, but that's it. You're not going to sink, and that's the issue because buying certainty with cash. A lot of people are tempted to do that, especially if your family doesn't have a history with money. If you're the first person, the first generation to actually be able to invest, volatility is a scary thing. And your parents are surely telling you, are you crazy? Why would you buy something called Microsoft? What would you do with that? You can't eat it or whatever. Just put your money in the bank and it goes up every day. So be careful of certainty. Certainty is often the most expensive decision. And I think a lot of people ignore that and maybe they don't even know about it. So things going up or down, volatility, you actually need that. And often incredibly volatile times are great opportunities. In a big crash like 2008 or, in the middle of the COVID crash, if you were able to kind of keep going with your monthly investments and keep buying, into the stock markets and the bond markets and those kinds of things, scary to do because the world was kind of ending. We weren't sure if we were going to all wake up tomorrow, but it was a great time to be an investor. And you didn't need to be a market time. You just stuck to the strategy. So I think volatility, yes, it's frightening sometimes, but sticking the course, staying the course is a way to go in those kinds of crazy times.
Yeah, and an easy way to hack the system in a sense to ensure that we don't make those knee-jerk reactions, which we will likely want to do. It's no fun seeing your portfolio dropping by 20-30%, even if you are an experienced investor. We're talking in front of you, we also experience that pain, seeing that it's not fun for anyone. But in order to try and mitigate that risk of you selling now, having that big ship that's sturdy, you're not going to start poking holes. You see a big wave coming, that's not going to make sense. So automate the process, automate your investments, let those debit orders go off after you get your salary. And don't log into your investment platform every 10 minutes. It's going to drive you mad. Just let spend a lot of time choosing the right type of funds for the specific goal that you're investing in. Do proper research. But once that strategy is in place, don't go and change something that's not broken. Don't go and try and fix it if you shouldn't do that. Because if you automate this and the markets go up, that's good. You're making money. If the markets go down, it's also good because you're buying at a discount and your average buying price actually decreases as the markets fall. And as long as you are investing in proper type of ETFs and companies that has a good track record, then it should recover at the end. Now, again, we're not saying if you go and do other silly stuff and gamble in small stock or alternative investments, that's another topic. But automate the process, buy rand cost average, dollar cost average into the market, and let your investment portfolio do what it does best. Let it allow it to do the heavy lifting, because the compounding effect will bring the strength to your portfolio. So once you've kind of packed all the different types of goals that you want to invest for, and you've got a strategy for each one, automate that process, and then almost forget about it until you need that money. I think that just helps to alleviate a lot of the stress that goes along with investing. You can't stress about something that you're not even aware of. If you don't look at your portfolio, it's not going to stress you out.
Yeah. And asking yourself those what if questions, I think, is always a problem. When you read the news and you say, what is this going to do to my investments? What if the world ends? Look, if the world ends, we're not here anymore.
Yeah,
it doesn't matter.
It's going to matter, yeah.
If the financial system collapses, we all need to be farmers again. Yeah. So I just think those existential threats to humanity, to the world, I'm not saying that they might not happen, but there's nothing you can do about it. So kind of ignore those and focus on the things you can control. In the investment world, choosing, if you're saying, look, I'm young, I'm going to put my money away and I'm just going to let it do its thing, choosing a balanced unit trust, an exchange traded fund that's a combination of those kinds of things, doing that is actually a pretty simple thing to do. A lot of that asset class decisions are made before the time. As you said, if you choose a balanced fund, it's got mostly shares, others, a combination of cash and bonds and property as well. Then the decisions are made for you. And so you just keep going with your monthly debit orders. A lot of those will also have a good overseas allocation. So all of the big calls are made and you can carry on. If you're more involved, then making that decision to say, I need to be at that 75% level in shares. The other thing maybe is just once a year and not more frequently than that. Just check. Am I still at 75% in shares? The markets have been booming, and your allocation to shares is now at 95%. There is nothing to think about. You were supposed to be at 75. The markets have given you 95. Get yourself back. So sell some of your shares, take some profits. It's not a bad thing to do. Allocate the money elsewhere so that you've managed the risk of what you're doing. It's horrible to do when your things are booming and then you now sell some of those very profitable things. But you would love that decision if you sell and then 5 weeks later the markets collapse, because then you're not overexposed to the risky assets far beyond what you were supposed to be. So that's maybe a way. If you're a bit more of a DIY, check your asset allocation once a year. If you're not and you're a fire and forget person, choose a balanced fund if that's what you need to do, or a cautious fund if that's what you need to do, and then let the investment do its job, as you said.
Yeah, and we're mostly speaking now for those pre-retirement. In the phase of building wealth, I think it becomes more nuanced once you are retired, and then it really becomes important how you allocate your assets and how much you draw down. A lot of people think once I retire, I should not take any risk, or building up to retirement, I should de-risk to the point that I'm just sitting on cash. But you have to remember, if you retire at 65, you still have a good 20, 30 years to invest for. So that's still a long time horizon. So doesn't it change a little bit in terms of now, instead of just adding money, we're drawing, and there's this reason not to go too risky, especially in the beginning couple of years. But then it becomes important to balance drawing an income, but also getting growth, which is maybe a topic for another day. I think we're close to our time now. But so again, essentially, investing is a lot better than not investing at all. And what you should be careful of is over-analyzing everything and kind of being overwhelmed, and that leading to inaction, and you go and spend that money. Investing any money in any asset class is already better than not investing at all. But it's important to understand the fundamentals of what actually drives returns. And yes, taxes play a role, and they help us if it's tax-free and tax-efficient and tax-deferred. That's great stuff. It's nice to know that we are in specific investment vehicles that allows us certain benefits. But ultimately, your best investment choice would always be your asset classes. That's the message we're trying to drive home today.
Yeah, and I think I have to talk about the retirement one for a second. I like the idea that your asset allocation at age 63 and at age 68 doesn't change. I think that means you've done it correctly. because you might have 30. I'm planning for 95, Pieter. So it's retiring at 65. I've got 30 years of life. It's a heck of a long time, and so you've got to keep your asset allocation, especially your exposure to shares, high to beat that cost of living. And then maybe just very last point is, investing is your job. It shouldn't be your hobby. And I think if you want to talk about your investments all the time, I think you've said it in a previous episode, take 5% and make it your fun money. It could have been money that you would have spent on a car or the casino. You happen to go and choose something that you think is going to do brilliantly. Which is probably likely, that it halves, then it doesn't damage your financial position too much. If it doubles, well done. You can tell everyone at the braai or the dinner table that you're a genius, but don't do that with a big chunk of your money. Investing should be boring and predictable and rewarding over decades. It should not be exciting. If it's exciting and entertaining, you're doing it wrong.
Yeah, that's very important, especially in today's day and age where everything needs to be exciting. Being a successful long-term investor comes down to doing the basics, developing good habits, and being consistent over many decades. That's what's going to drive real results. And yes, if you want to have fun, use the 5% and go enjoy yourself. But the majority of your wealth should be focused on the basics, and that has been proven time and time again. That's actually resulting in what you need.
I think that's all we have for today. Thank you so much for watching and for listening, and we appreciate it. Don't forget to subscribe to our YouTube channel, and we'll catch you on the other side.
Thank you so much. See you next time. Bye.
The Stradivarius violin is considered to be the most emotive instrument in the world. That's why you'll often hear it in investment ads, adding drama and the utmost importance to their philosophies, or for the announcement of a fancy new fund manager. 10x Investments don't need dramatic instruments to seem impressive. They let the results sing for themselves. So 10x your future without the drama. 10x is a licensed FSP.